Hi, this video will discuss the welfare impacts of a sales tax, how the sales tax impacts consumers, their consumer surplus measure, how it impacts producers, the producer surplus measure, how it impacts the market as a whole, total surplus, and we'll also show you how the sales tax creates a deadweight loss. So first, let's talk about the impacts of a tax. Suppose you have a sales tax. What's going to happen to the price consumers pay? It's going to go up. This will generate a smaller consumer surplus or a loss in consumer surplus. What's also going to happen from a sales tax? The price the sellers receive or the firms receive is going to drop. So this reduces the size of the producer surplus. So to summarize then, a sales tax harms consumers, creates a smaller consumer surplus. It harms producers. It creates a smaller producer surplus. So who wins from a tax? Of course, the government wins. It creates some tax revenue that it didn't have before. Now we want to talk about what happens to total surplus. And we'll show you this graphically, but what we'll find, even if we include tax revenue in the total surplus calculation, the total surplus still shrinks when there's been a sales tax imposed. So here's the scenario. What's going to happen to our welfare if we impose an 11-cent tax on the sellers of roses? What happens to consumer surplus? It drops. What happens to producer surplus? It drops. What happens to tax revenue? It increases. What happens to total surplus? It drops. Who benefits when a tax on roses? The government. Can you support your interest with a graph? And can you also show the deadweight loss due to the tax? So let's show that here in this market for roses. And it's helpful when you see a tax question to ask what it would be the equilibrium price and quantities and surpluses before a tax occurred. So what's the price if we don't have a tax on roses? The tax would be 30 cents. Sorry, the price would be 30 cents. And what's the quantity? The quantity would be 1.25. What's the equilibrium? Would be this point here. So the consumer surplus areas are going to be A, are going to be B, are going to be C before we tax it. The producer surplus areas are going to be D, going to be E, and going to be F. Now, I have recorded previous videos on consumer surplus and producer surplus. So take a look at these if these concepts are not familiar to you. So what's the total surplus before a tax? It's going to be all these letters that I've checked. A, B, C, D, E, and F. So that's the basis we're comparing things to. And what's the deadweight loss before a tax? There is none. It's zero. So now let's compare that scenario with having a tax imposed of 11 cents. So how do you do this 11-cent tax? Well, 11 cents here is the difference between 32 and 21. Okay, well, where do we get that 11 cents from? It's this vertical distance between our original supply curve and go up until you hit the new supply curve, which is drawn 11 cents north of the original supply curve. So this is the supply curve plus 11 cents. And that's this vertical distance between these two curves is 11 cents. Okay, got that? 11 cents is the vertical. So from this point to this point, E2 is 11 cents. So that's the tax amount. So this is the wedge. Okay, where this tax wedge of 11 cents hits the demand curve will tell you the new price the buyer pays. The new price they pay is 32 cents. And where it hits this original supply curve, that's the price the seller receives, or 21 cents. So those are the new prices. And so where's the consumer surplus now after the tax? It's just A1, because that's the area above the price and below the original demand curve. So where's the producer surplus now? Well, the price the producer gets to keep is 21 cents. And that's going to be 21 cents in the area above the original supply curve. So this area F only. Where's the tax revenue? Well, tax revenue is going to be this 11 cents. They're going to sell 1.16, so a reduction. But the tax revenue is area B and D. So where's total surplus? Total surplus then are these areas that I've checked or circled. It's A, it's B, it's D, it's F. So what areas did I not check or circle? These two areas here, C and E. So C and E are the deadweight loss from a tax, because this is the total surplus reduction. Before we had a tax, we said all these areas, A through E, A, B, C, D, E, and F, were all total surplus areas. Now it's just these four. So this is what we lose out on by having a tax. This is why the tax harms consumers, producers, and society, because it drives a wedge between buyers and sellers.